Welcome to Chapter 7 of Mercury Investors Trading Program, the final chapter. In this chapter, Abdul is going to be going over a few concluding points and talking a little bit about the psychological side. If you've enjoyed this series of videos, please hit that subscribe button because there's a lot more to come. We also have a Discord channel where we'll be talking everything stocks and giving out our own personal calls, so be sure to check that out, link down below. Without further ado, enjoy the final chapter.
So let's get straight into this final video of this beginner course which we've set out for you. So in this video, we'll go over trading psychology and we'll go over some examples of actual trades that we've taken and tips and tricks of trading itself. So in terms of psychology, this is possibly the most important thing outside of your risk management. Your trading psychology will be your mental attitude, and that's going to be the thing that impacts how you make decisions and what decisions you actually make. So you need to have the right mindset to make money. So what does this all mean? Well, in trading, consistency begins with your psychology. So you need to understand that you're trading to make a sustainable income and become financially free, as opposed to having a I need to retire next week mindset. People with that mindset will overexpose and over-leverage their accounts, and they're likely to blow their accounts really quickly because of their lack of discipline. They start by risking ridiculous amounts and hope they win. At that point, they're gambling. Stick to your 2% risk that you've identified and you'll make much better and more consistent returns than risking various high amounts, hoping that you win. So, over-leveraging, what is that? Well, over-leveraging is just using lot sizes way too big for your account. It means that you become emotionally attached to what you have to lose and you're more focused on the money itself than the trade. If a trade goes into drawdown, it's natural, but if you over-leverage and a trade goes into drawdown, it might still be a winner, but you'll probably close out early and never actually find out. So stick to your trading plan and your risk percentage and you'll see much better, more consistent returns. The mindset of I followed my trading plan and risk managed properly should always be taken, because this mindset allows you to brush off your losses and enjoy your winners when they come even more. So how do you trade with the mental attitude? What is the right mental attitude to trading? You have to trade like you're in business. You have to treat your trading like a business. In every business, there are costs and expenses, and that's how you should see your losses. Your costs should always be less than your income, and that's the same in trading. For example, a clothing shop will buy 10 shirts, will buy 200 shirts for $10, but sell them for $30, meaning that they may buy 200 shirts and only sell half, and they'll still make $1,000 profit, which is equal to 50%. And who doesn't want a 50% return? Exactly. Trading is the exact same principle as that. And once you have that psychology, that decision making, you'll see it in your results. So, in terms of psychology, once again, after analysing a currency pair, you have to ask yourself if the trade is worth it. Is the potential return worth the potential loss? For example, if your stop loss is 50 pips and your take profit is also 50 pips, the trade is not really worth it because you only have what you have to lose to gain. Your risk-reward ratio is 1 to 1. If your stop loss is 50 pips and your take profit is 150 pips though, it's definitely worth it because you have a 3 to 1 return ratio. Which means if you risk 2% and it comes out, you'll make 6% back. The bigger the potential reward, the better, especially as your risk remains the same throughout. So, let's get into the actual trade examples. Here's an example of a trade I took, and you can see a few of the things that we've learned over the course already here. You can see a trend line, there's your first touch, there's your second touch, there's your third touch. You can see your support level, which is here, 1.32982, which actually turns into resistance after it's broken here, as you can see. You can see here with the price action, you see 3 big wicks, 2 big wicks, and they are in line and creating a double top on the third touch. So that's a really nice confluence. So let's take a closer look at this trade. You see here, this is the second touch, or the third touch of the trend line, and the confirmation of the double top. And you see here, you have tweezer tops here, right here. You see two evening star candle formations here and here. You see a 30-minute resistance level that just failed to break. As you can see, wicks rejection there, rejection there, rejection there, rejection there. And yeah, you can just see a lot more once you take a closer look, like we mentioned in the multi-time frame videos. You see more on the price action side of things, and it lets you know that you're getting into the trade at the right time. So here you get tweezer tops here, tweezer tops here, and these tweezer tops makes a evening star candle formation, which price never really comes back to that level after that. It just went down, down, and down. And you'll be able to do that if you go through all the things that you've learned in this course and you analyze it, you study it, and you understand it. So, now what do? Well, you take everything that's been taught in this course and you just go to the charts and test it out. You test it out on different charts, you use different time frames, and you really find what combination of confluences works best for you, your trading, and your lifestyle. Because at the end of the day, the reason we're trading is because we can save ourselves time by not having to work 40 hours a week. And we can do the things we want because we have a near unlimited resource of money should you become a profitable trader. So you need to find out what works best with your lifestyle and your preferences as well. So in conclusion, you need to remember a few things. For once, no strategy wins 100% of the time. It's just not possible. You have to be aware of why as well, which is news events and how they cause volatility, as well as, like I mentioned earlier in the course, the way banks actually behave in the market. It's best to stay away from the market when big impact news is dropping, as you can find yourself on the wrong side of a heavily losing trade. And if it's really, really volatile, like interest rates or non-farm payrolls, you could find your stop loss slipping and actually losing more than you originally planned for. So just to end it off here, I'd like to wish you all the best of luck in trading, and hopefully we can see you all become profitable traders in the near future. Thank you.